Alright, hey guys, Scott here again with a brand new live trading video. In this one, we're going to focus on the calendar spread strategies. So basically, I'll be giving you a very in-depth tutorial of this strategy, and we'll dive into a live demonstration of when to use it and how to put it on, of course. And also, we'll discuss the specifics of how the strategy works, and also we'll dive into the risk profile of the calendar spread, and I'll show you in which situations you would make money and also which scenarios you would not make money in. So definitely a lot to unpack in this video. But as always, before we get started, make sure you guys watch until the end of the video, because at that point, I've got a very cool limited time opportunity for you all where you can receive up to 10 free stocks, and each stock could be worth up to $2,500. And also, if any of you would like to join a very exclusive online community where you guys can really learn how to successfully trade options, then you can now join my options trading Discord. So make sure you guys check out the description of this video below, because I do have links to a separate video that will tell you all about the Discord and discuss the main features and benefits, and also a link to my sign up page where you can join and begin your 7-day free trial. And then finally here, for anybody who is brand new to the channel, again, my name is Scott. And you can also find me on Skillshare as well, where you can take my very detailed classes on options trading or stock market investing. And you will also find some links to a few of my introductory courses in the description of this video as well. So be sure to check them out. And when you sign up for Skillshare using any of those links, you'll get a full 1-month free trial. Alright guys, so now diving in here, and first up, just conceptually speaking, what is the calendar spread? Or more specifically, what is its purpose? And the answer to that question is simply that it's a strategy meant to take advantage of an increase of implied volatility. Now, implied volatility, in case you're not aware, is simply one of the many factors used to price option contracts, and it basically refers to the uncertainty or fear about a certain stock's future. But ultimately, the bottom line here is when implied volatility does expand, right? When people get more fearful or uncertain about the future, then option prices will go higher. And then conversely, when implied volatility contracts, option prices go down at the same time. So for example, in this chart here, I'm showing you SPY, which is an ETF that tracks the S&P 500. And then specifically, if we come down here, this chart at the bottom is showing you the implied volatility for SPY. So obviously, as you can see here, implied volatility does fluctuate quite a bit on a day-to-day basis. And the most important thing to know about implied volatility, or the relationship between implied volatility and stock price fluctuations, is that the vast majority of the time when stocks do sell off in a very significant way, then you are almost guaranteed to see a huge expansion of implied volatility, or a huge expansion of fear and uncertainty in the market. And hopefully that is pretty intuitive. Right? Because most people involved in the stock market are simply buying stocks or investing into index funds and are basically long, they're bullish for the long term. So of course, naturally, when stocks go down very abruptly and in very large amounts, people tend to get scared. And that fear, that uncertainty now is what causes option prices to increase substantially. And so again, that is the main purpose of using the calendar spread. You are trying to make money off an expansion of implied volatility at some point in the near future. And ultimately, given the relationship between implied volatility and stock price fluctuations, specifically as stocks come down, you almost always see implied volatility go higher. That means it makes the most sense in most situations to use the calendar spread with put options. So even though you can use a calendar spread with call options, it's not going to be the best use case for it, because again, with a put option calendar spread, this is going to do two things. Number one, it's going to take advantage of stock prices coming down, hence the put options. And then also, as I explained, when stocks go down, implied volatility expands. And that's, again, the main point of using the calendar spread. And so in particular with this SPY chart, and we'll go ahead and zoom in a little bit here. And so as you can see here, a lot of my analysis on the charts is based pretty much off of support and resistance levels. And right now, SPY is getting close to what I see a major support level. So I do see some more downside for SPY to come in the near future. And also, generally speaking, I am bearish on this market as a whole. So we could also see this support level break as well, and therefore make newer lows. But in particular, this support level comes in at right around 365-ish bucks per share. So therefore, I'm going to keep this price in mind when creating my calendar spread. Right? Basically, this is going to be my target price for SPY to fall down to, and then hopefully, if and when that happens, we will also see an expansion of implied volatility as well. And so now with that being said, we'll come over to the trade tab and take a look at the option chain for SPY. And so in particular here with the calendar spread, it's composed of two different pieces. There's going to be a long put option in a further expiration cycle, and then a short put option in a nearer term expiration cycle. And so for the sake of example, we'll go into the August 1st weekly cycle. This is going to be our nearer term cycle. We'll unfold this tab here and scroll down to the near at the money options. So right now SPY is around $375 per share. And like I showed you on the charts, my target price at least is right around $365 per share. So this here is going to be the put option that I'm going to sell. And actually in thinkorswim here, there's a very easy way to set up an entire calendar spread in one order. So I'll right click on the put option here and then go to buy, which might be a bit confusing here because again, we're technically going to sell this put option, but the entire order is going to be routed for a debit. So we'll go to buy and then calendar, click on that. And here we go. This is the order down here to sell one contract of the August 1st 365 strike put option, as I said. And then also at the same time, we're going to buy one contract, also a put option with the exact same strike, but it's going to be in a further expiration cycle. So in particular, I'll change this and go a bit further out, perhaps to the August 19th monthly cycle. So now as you can see here, these two expirations are separated by about 18 days. And then like I said over here, the entire order is going to be made for an overall debit. And that's because the option we're buying here, the one in a further expiration cycle, this option is always going to be more expensive than the nearer term option, right? And that's just because options with more time baked in are always going to have higher prices. And so this right here is the basic setup for a put-based calendar spread. But now, how exactly does this position here take advantage of an increase in implied volatility? And the answer to that question has to do with the vega values of the put options. So for example, in case you're not aware, the vega of any option contract will tell you approximately how much the price of this contract will change for a 1% move in implied volatility. So in this case here with our 365 short put option in the August 1st cycle, if implied volatility for SPY goes up by 1%, then the price of this put option will also increase by about $30 or 30 cents on a per share basis. And then conversely, if implied volatility goes down by 1%, then the put option here will also go down by about $30. That's it. Now that being said, the key here about vega is that options with further expiration cycles will have larger vega values. So for example, if we scroll down to the August monthly contracts, which is right here, August 19th, we'll unfold that tab. And then we'll find the 365 put option in the cycle, which is going to be right here. And now as you can see here, the vega for this option is 44. So now the full picture here is, let's say implied volatility for SPY goes up by 1%. Well, in that case, we're going to make about $44 of profit on the long put option, right? Because again, we bought this contract. So therefore, we want the price of the contract to increase, but also the price of the short put option contract is going to increase by about $30 as you saw. So therefore, whenever you sell an option as an opening trade, if the price of that contract increases, you're going to lose money. So bottom line here is, again, if we profit $44 on the long put option, but we lose, scrolling back up here, if we lose $30 on the short put option, well, the net effect is you still profit $14 in total, right? 44 minus 30 is 14. And that's literally it. That's how the calendar spread does make money if implied volatility does expand. That's the whole point of the strategy. Now, also one question you might have is, why do I even need to sell this put option in the first place if implied volatility does expand? That's what I want if, in this case, I'm going to lose money on the short put option, right? So what if instead I simply just purchased the long put option and did not sell a put option at all? Wouldn't that possibly be better? Well, in that case, if implied volatility did expand very, very soon, perhaps tomorrow, then yes, you would make more profits on that expansion with just a long put option. But also you do have to keep in mind, what if implied volatility does expand perhaps 1, 2, or 3 weeks from now? And therefore, during all that time, your long put option is going to be losing value because of time decay. And so that is why you do need to sell that shorter term put option, because when you sell options, time decay actually works in your favor. You make money off of time decay. So the the profits on time decay from the short put option will offset the losses of time decay from the long put option. So for example here, let's scroll back down to our long put option in the August 19th cycle right here. Now take a look at the theta values for this put option here. It's minus 17. And theta will tell you approximately how much money you will lose on this put option, or basically how much the price of this option will fall every single day that passes. So everything else being equal, come tomorrow, if SPY is around the same price and implied volatility has not changed, then the price of this contract will fall by about 16 bucks. And again, because this here is the option we purchased, that's going to cause you to lose money. But the good news though, if we scroll back up to our short put option in the August 1st cycle, as you can see here, the theta value for this contract is 22. It's even larger. And that's a cool thing because options expiring sooner will have a faster rate of time decay. So now by pairing your long put option with this short put option, that means come tomorrow, again, everything being equal, you will profit about 22 bucks on the short put option, but you will lose about 17 bucks or so, or now 16 bucks on the long put option. So therefore the net effect is you still actually make about 6 bucks. So there you go. That's the purpose of the short option component of a calendar spread. It mostly just serves to offset the time decay on the long put option. But because the short option is in a nearer term expiration cycle, that's what allows the entire position, right, the full calendar spread, to still make money from an increase in implied volatility and also not be impacted by time decay. And so now before I go ahead and send in this order, let's also put it onto the Analyze tab so we can see the risk profile. So I'm going to right click on this order here and go to Analyze Trade. And there you go. As you can see here, this is a diagram showing you an approximate payoff or loss for this position based on where SPY moves in the future. Right? So as you can see here on the x-axis, you're seeing a possible range for SPY prices. And then on the y-axis, this shows your approximate profit or loss, again, based on where SPY moves. Now I do say approximate payoff for a reason, and that's because with a calendar spread, you actually cannot define your max profit or your break-even points on this kind of strategy, right? So the calendar spread is not like a credit spread, for example, where you do know ahead of time what your maximum profit is going to be or your break-even points. That's not the case here with this position. Now that being said though, you do always have a limited loss potential with a calendar spread as well. And that maximum loss is simply equal to the debit paid to enter the position. So for example, in this case here, if I were to send this order and get filled at a debit of 316 or 316 bucks, this would be my maximum loss on the trade. But again, for the max profit, even though right now it's showing me an approximate value of around, call it 530 bucks or so, this number here is simply based on today's variables, today's numbers, in today's market environment. And ultimately, the real reason why you cannot know ahead of time how much your max profit on this position could be is because there is no way to know where implied volatility is going to be by either expiration date. Right, so that is the main unknown variable for this position. And because it's unknown, that's why your break-even points and your max profit are also unknown. But that being said, we still do know for certain which price for SPY would yield the max profit, whatever that max profit may be. And so as you can see here on the payoff diagram, specifically looking at this blue line right here, the max profit would occur right at your strikes of $365. Now, why though is this the case? Well, let's say for example that by the August 1st expiration date, which is the expiration for our short put option contract, right? Let's say by that date, SPY has fallen, which you can see right here. This is the current price of SPY. Let's say this ETF has fallen in price all the way down to exactly 365. So therefore, in this case, the short put option contract will expire worthless. It just goes away and you keep the full premium that you sold it for. Additionally, because SPY moved downwards in price, that's going to increase the price of your long put option. Right? Because that's just how put options work. When the price of the stock goes down, the price of put options go higher. And because the time decay for the long put option here was totally offset by the short put option, you will indeed make profits on the long put option if SPY falls down to 365. And so that's why on the diagram here, that's why you see an increasing amount of payoff as SPY does move lower and lower. And then also, of course, as this is happening, like I explained, when stocks do sell off, you almost always see an expansion of implied volatility. So bottom line, the full picture here is if you get both a downward move in SPY and an increase in implied volatility, you definitely will make some nice money on this overall calendar spread position. But once more, because we don't know how much implied volatility could expand or contract by the August 1st expiration date, that's why we really do not know what the max profit could be by that time. And so pretty much every day that passes, this diagram here is going to shift and change. Now also here, what about the possible scenario where SPY does continue to move higher? And therefore by both expirations, right, basically by the August 19th expiration, what if SPY is simply much higher than where it is right now? Well, in that case, both of these put options here will expire worthless. They just go away and you lose the full debit you paid, $316, and that's it. And then lastly here, the third possible scenario is what if SPY really just collapses and falls way below our target price of $365? Well, in that case, then by the August 1st expiration date, your short put option contract, you will get assigned on that option and therefore have to purchase 100 shares of SPY at a price of $365, right? So therefore, to cancel out of that assignment, you'll have to exercise early your long put option contract, which therefore allows you to sell those same shares at the exact same price. So bottom line, if you buy at $365 and you sell at $365, you don't make or lose any money on the assignment, but you will still forfeit the entire debit paid when first putting on the position. So once more, in this case, your max loss on the trade is still $316. So basically for a put-based calendar spread, right, you still do want the stock price to fall down and also imply volatility to expand, but you also don't want a crash scenario to occur either. So ultimately, if you do get a moderate move for the stock price in your favor and also an expansion of implied volatility, then you will see the price of this full calendar spread increase substantially. And at that point, you can sell out of the spread and book your profits, right? Where basically you would sell the long put option and buy back the short put option and close the whole trade. Of course, you could also wait until the expiration date for your short put option, but the chance that by that time SPY is going to be exactly at 365 is almost 0%. So even though at this price and at that time you would make the most amount of profit, but because the chance of that happening is so low, then in my opinion, you should take your profits if SPY does move down a decent amount and you also see a nice expansion of implied volatility. So for example, if that happened and therefore the price of the spread went from 316 to maybe it went up by 50% or even 100%, then that would be a great place to take your profits and close the whole position. And so finally, with all that being said, let's come back to the trade tab here and make this order official. So I'll try and lock in a price of maybe $320, try and get filled immediately here, go to confirm and send, and we'll send the order. And there we go, just got filled and price improved to 314. Awesome. And so there you have it. That is the calendar spread and all the specifics and details that you need to know to properly trade this strategy. So I hope everything made sense, but of course, if not, please do post your questions or your thoughts in the comment section below. And lastly, here in this video, I do have a very cool limited time opportunity for you all where you can receive up to 10 free stocks. So basically, there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, for a limited time, they're offering you the opportunity to receive up to 10 free stocks when you open a brokerage account with them using my link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced, yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the description of this video to sign up and get your free stocks. And also don't forget to check out and sign up for my options trading Discord, as well as my Skillshare courses. Links also in the description of this video. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.